Good evening, students. Welcome to the session. So, I hope you're very clear with what we discussed in the last class on PGBP. So, we did very comprehensively the entire chapter of PGBP. We solved many questions around that on almost all the areas of PGBP. And I would request you to keep revising that because that is the very, very important topic and will form base for all the questions which you would get it in examination. Okay, so now today what we are going to start is the next topic, which is capital gains. So let's get quickly started with it. So our next topic is capital gains. Okay. Like in PGBP, we had the charging section under 28, the general charge. And then we had the specific charge, right? Similarly, you would now observe in the capital gains as well that there would be general charging section and then there would be the specific charging section, right? So let's quickly start with it. Now, section 45. Section 45 of the capital gains is the charging section, and 45 clause 1 is the general charge. Now, what does 45.1 says? 45.1, which is there, is in respect of the general charge in the head, under the head capital gains. And what does it provide? So it provides that, let me just put it up here, the bare text of the section. Yes. Any profits or gains arising from the transfer of a capital asset. So here, two things are very important. Transfer of a capital asset. Effected in the previous year shall, as otherwise provided in sections 54 to 54H, be chargeable to income tax under the head capital gains and shall be deemed to be the income of the previous year in which the transfer took place. So, what does it say? 45.1 says that the profits or gains from the transfer of a capital asset. The transfer of a capital asset shall be chargeable under the head capital gains and shall be deemed to be the income of the previous year in which the transfer took place. So income will be considered in the year in which the transfer is taking place. Now, let's try and understand what is the meaning of the term capital asset and the meaning of the term transfer. Now, if we see, first transfer is defined under section 247. Transfer is defined under section 247. So first we are looking at the meaning of the transfer, right? Because it says transfer of a capital asset. So 247 provides that what will be a transfer? 247 provides that the transfer of a capital asset means extinguishment, relinquishment, sale. Am I audible? Hello? Am I audible? I think my net is not working. Okay. Okay, sure. Yes. So, section 247 defines the term transfer. And how does it define? Let's try and understand the meaning of the term transfer. Sorry. So transfer in relation to a capital asset includes, this is the inclusive definition. This is the inclusive definition. Sale, exchange, relinquishment of asset, extinguishment of any rights, compulsory acquisition under any law, conversion of capital asset into stock in trade, possession of any immovable property, transfer or transferring or enabling the enjoyment of immovable property and maturity or redemption of zero coupon bond. Maturity or redemption of the zero asset. And then there are further additions to that. We are going to discuss each one of this in detail. What is sale? Sale means that whenever I am selling to you any particular asset, it's a normal sale, right? It's a normal sale which is happening. So sale is the transfer of the ownership of the asset. Correct? Exchange is what? When I am exchanging one particular property or asset for the another property, right? So when two people mutually transfer the ownership of one thing for the ownership of the another, right? And that is not in money, because sale will be in money, but the exchange will not be in money. Then relinquishment of the asset. What do we understand by the term relinquishment? Relinquishment is not defined under the Act. Here in the relinquishment, so that is the meaning of the relinquishment. Extinguishment of any right. Extinguishment refers to the extinguishment of the asset itself. When the asset itself gets ended or gets destroyed, right? Then we have compulsory acquisition under any law. So acquisition of the immovable property, acquisition of any industrial undertaking, when they are compulsorily acquired by the government, when the government compulsorily acquires the land, that is the compulsory acquisition. Conversion of capital asset into stock in trade. This is very simple. We have already seen example of conversion of stock in trade into capital asset. Here they are saying about conversion of capital asset into stock in trade. Conversion of stock in trade into capital asset is in PGBP 28(5)(a). Correct? Possession of any immovable property. So what does it mean? So where there is a transaction involving the allowing of the possession of the immovable property to be taken or retained in part performance of the contract under the Transfer of Property Act. So that is considered as transfer. Or any transaction which enables the enjoyment of any immovable property, which has the effect of transferring or enabling the enjoyment of any immovable property. Correct? So whether by way of becoming the member of or acquiring shares in a cooperative society, so that is considered as transfer again. And maturity or redemption of zero coupon bond. Are we clear? But this is the inclusive definition. Then there are certain exclusions also which are given under the 47. The transactions not regarded as transfer. So these are the inclusions which are there, and there are the transactions which are specifically exempt under section 47. Transactions not regarded as transfer. That we will be dealing one by one as and when the need will arise. Are we clear? So that I am not touching upon as of now. Clear? So that I'll be telling you whenever there would be a particular transaction where we would be referring the details, because there's a big list if you see. So transactions, or I would write here minus transactions not regarded as transfer under section 47. Clear? So this is the meaning of the transfer. We have seen that now. Now, what is the meaning of the term capital asset? What is the meaning of the term capital asset? Capital asset is defined under section 2, subsection 14. Capital asset is defined under section 2, subsection 14. Now, 2 subsection 14, how does it define capital asset? Capital asset. Capital asset means tangible plus the intangible property of any kind. This I am writing, this is not part of definition. But it means property of any kind. So it could be tangible or intangible property. Property of any kind, right? Held by the assessee. Capital asset means property of any kind held by the assessee. Whether or not connected with his business or profession. Whether or not connected with his business or profession. So it includes property of, it means property of any kind held by the assessee. Property could be tangible or it could be intangible. Clear? For the foreign portfolio investors, FPI, or foreign institutional investors, FII, any security held by FII or FPI is always a capital asset. So for an FPI or FII, even if he is trading in the securities, even if it's their business to deal in securities, but still that would be considered as the capital asset. Are we clear? That would be considered as the capital asset. So any security held by FII or the FPI. Any unit linked insurance policy, ULIP. Any unit linked insurance policy which is issued on or after 1/4/2021, which is issued on or after 1/4/2021, to which exemption under section 1010D, does not apply. So any ULIP issued on or after 1/4/21, to which exception or to which exemption under section 1010D doesn't apply on account of premium payable greater than 2.5 lakh, where premium is payable greater than rupees 2.5 lakh. So even that is considered as the capital asset. Correct? So first is 45(1). What does it say? Any profit or gains arising from the transfer of a capital asset. So transfer is defined under section 247. Capital asset is defined under section 214. Right? It shall be deemed to be the income of the previous year in which the transfer takes place. So there should be transfer of a capital asset, and under section 240, and it will be deemed to be the income of the previous year in which the transfer takes place. Now, under capital asset definition, I am not yet finished. There are two parts. Let me make it like this. Capital asset under section 214 means, and second, it excludes. Second is the excludes. So what does it exclude? We have seen the means part. First is stock in trade. So stock in trade is excluded from the definition of the capital asset other than securities held by FII. So if it is security held by FII, even if it is treated as stock in trade, that would be considered as capital asset. Second, personal effect. Personal effect. But again, there is exclusion to the exclusion, which means these items will be included or will be treated as capital asset. What are these? Jewelry, work of art, archaeological collections, drawings, paintings. So these are considered as capital asset, right? Then certain notified bonds, for example, 6.5% gold bonds, defense bonds, special bearer bonds, gold deposit bonds, right? Those are excluded. And finally, rural agricultural land. Now, what is rural agricultural land? That is provided. So, rural agricultural land is any land which is in any area within jurisdiction of municipality or cantonment board having population of 10,000 or more, of greater than equal to 10,000. Right? So, a rural agricultural land is any land, is any land which is not being situated in any area within the jurisdiction of municipality or the cantonment board having the population of greater than equal to 10,000. So which is not situated in any area which is falling within municipality or cantonment board having population of more than 10,000, or is not urban land. Now what is urban land? The limits are defined for that. So urban land means land situated in any area within the jurisdiction of municipal corporation or a cantonment board and fulfills the following condition. So there are the limits for the population and distance from the municipal corporation, right? So greater than 10,000, less than equal to 1 lakh, up to 2 kilometers. Greater than 1 lakh, less than equal to 10 lakh, up to 6 kilometers. Greater than 10 lakhs, up to 8 kilometers. Are we clear? Shruti, I'll take up the PGBP doubts later on. Relinquishment means, Jacob, that if the interest in the asset is relinquished, abandoned, or surrendered. So in that particular case, the asset is there, but my interest is relinquished. Dilip, foreign portfolio investors are the foreign investors who invest in the stock market. Are we clear? SGB is taxable. We'll be dealing with that separately, Aniket. Any other doubt? Okay. So, as I said, the capital asset has definition has two parts. One which includes the means part, so the one which is the means part, which defines the capital asset. And then there are the exclusions from the capital asset. So for the purpose of section 45(1), there has to be first the chargeability. Under section 45(1), it will be chargeable or deemed to be taxable in the previous year in which the transfer takes place. Secondly, we have to see the definition of the transfer under 247, and then we have to see the definition of the capital asset under section 240. As far as the definition of the transfer is concerned, it includes sale, relinquishment, exchange, extinguishment, compulsory acquisition, conversion into the stock in trade, maturity or redemption of a zero coupon bond, possession of immovable property in consideration of the part performance of the contract, and transactions which have the effect of transferring or enabling the enjoyment of any immovable property. Are we clear? So, yes, the possession of the immovable property in transaction which have the effect of transferring. Let's say, for example, we become the member of a cooperative society, right? When we pay the amount, the society hands over the possession of the house. So that particular case is considered as the transfer. Are we clear? Any other doubt? Okay. As far as the capital asset, that is under 214. One very important point is that for securities of FPI or FII, it should be always considered as capital asset. It will never be considered as stock in trade, even if it is treated like a stock in trade. Clear? Yes, Shruti will be dealing with the PGBP questions later on. Okay. The short-term capital asset and two. Now, what is the holding period? Preference shares in a company. Then a security, units of oriented. So for 12 months, we have the security listed in a recognized stock exchange, unit of zero coupon bonds. For all of these, we have 12-month period. For unlisted shares and immovable 36 months. Clear? So 242A talks about short-term capital asset and 242B talks about short-term capital gain, which is arising on the transfer of short-term capital asset. And 229B talks about long-term capital gain arising on the transfer of long-term capital asset. Clear? So these are the three holding periods what we have for different asset category. Clear? Once you will have unlisted, all of that will be covered under the 36 months. Clear? Now, for the purpose of determination of the period of holding, from when you have to count the period of holding, there is explanation 1 to section 242A. Now that again we will be dealing as and when there would be the transaction which we would be discussing, the specific transaction which we would be dealing with. Are we clear? So we have done the definition of the transfer. We have done with the section 45(1) and the definition of the capital asset and period of hold. Now we would be moving towards the specific chargeability. We are moving towards the specific chargeability, which is now from 45(1)A onwards. This was the general charge. This was the general charge. Now let's move towards the specific chargeability. This is part 2, you can say, of this chapter, which is specific charge. And the first one under that is section 45(1)A. What is 45(1)A? Let's try and understand. So let's first read what the section says, and then I'll explain. Notwithstanding anything contained in subsection 1, meaning this particular clause is a non-obstant clause and this overrides the general charge. So specific charge of the capital asset, meaning the capital asset itself will get extinguished. So extinguishment of the capital asset is considered as transfer under section 247. Are we clear? As a result of flood, typhoon, or any other natural calamity, riot or civil disturbance, accidental fire or explosion, action by enemy, then any profits or gains arising from the receipt of such money or other assets shall be chargeable under the head capital gains and shall be deemed to be the income of such person of the previous year in which money or other asset was received. So, it overrides the general charge under 45(1). When it is overriding the general charge, what did it say? It said that it will be deemed to be the income in the year in which the transfer takes place. Right? But 45(1)(a) is override charge and it is saying that it will be deemed to be the income in the year in which the money is received. So therefore, this is a specific charge which is created for the purposes of the insurance compensation which is received. In the year 2010, due to the earthquake, building is destroyed. Due to the earthquake, the building is destroyed. Right? Now, I have received the insurance claim in the year 2012. Now, when the asset got destroyed in 2010, so transfer took place in 2010 because there was the extinguishment of the capital asset. There was the extinguishment of the capital asset, right? So therefore, here, if you see, 45(1)(a) is providing that if there is any extinguishment due to the destruction of any capital asset, here understand one thing, the definition of the transfer, it provides that extinguishment of any right in the capital asset. But here, the capital asset itself is getting extinguished. But since this is a specific chargeability, this will override all the general principles. Clear? Now, when the compensation is received in the year 2012, so the taxability 2012-13. Are we clear? And what will be the full value of consideration? Let's say I have received 60 lakhs as the compensation. 60 lakhs as the compensation. So my full value of consideration will be the money or FMV of asset received, which is in this case money is 60 lakhs, minus the cost of acquisition or indexed cost of acquisition, right? Let's say my cost was rupees 40 lakh. So in this case, it will be 40 lakhs. Correct? Then period of holding year will be from 2000. Let's say I've purchased this building. Let's say in year 2002. Or let's say make it 2002. Okay. So 2002 to 2010 or 12. What will be my period of holding? Will it be 2010 or 2012? Delete business asset or any other asset. So if you see the capital asset definition itself says that whether or not used for the business. So even business assets are covered here. So if you see the capital asset, what does it say? Whether or not connected with his business or profession. So every kind of asset is covered. When I say capital asset, it will also include business assets. So what will be the period of holding? Yes, Shruti, Dilip, yes, correct. It will be till 2010. So period of holding will not be till the year in which compensation is received, because that time the asset itself was not in existence. So period of holding is up to 2002 to 2010. Indexation again from 2002 to 2010. And year of chargeability, as I said, will be 2012. So this is my year of chargeability. Are we clear? Any doubt? Any questions? Any doubt? So 45 1A. Clear? Any doubt till now? Okay. Now, next one is 45 1B. 45 1A we have seen. Next one is 45 1B, which is in respect of ULIPs. Forty-five 1B. Now, what is 45 1B saying? Let's try and understand. So, 45 1B, which is there, is in respect of the ULIPs. And what does it provide? It says where any person receives the amount under a ULIP, where any person receives the amount under ULIP. So as I said, ULIP is considered, if the premium amount exceeds 2,50,000, it is considered as the capital asset, right? So this is the latest amendment which is there. So here, what does it say? Where any amount, again, if you see, this is notwithstanding clause, so which means it overrides the general charge. Where any person receives at any time during any previous year any amount under ULIP, to which exemption under section 1010D does not apply, on account of applicability of the 4th and 5th proviso thereof, which is of 1010D, because the premium is as premium exceeds rupees 2.5 lakh, then any profits or gains from the receipt of such amount shall be chargeable to income tax under the head capital gains and shall be deemed to be the income of such person of the previous year in which amount was received. So again, if you see over here, what does it say? That this shall be taxable in the previous year in which the amount is received. So you can write it down over here. Any amount received under ULIP which is not exempt under section 1010D on account of premium exceeding rupees 2.5 lakh. Amount will be income of the previous year. In which amount is received. Are we clear? Okay. Srinivasa, we have already done the surcharge rate for the cooperative society in the first class. Next is (45)(2). Conversion of capital asset into stock in trade. Like this ULIP, which was specifically covered under the definition of transfer, even the conversion of capital assets into stock in trade is specifically covered under the definition of transfer under section 247, right? Just now we did it. So now here, let's try and understand, and then I'll make a comparison between the conversion of capital asset into stock in trade and conversion of stock in trade into the capital asset. All right. So first, as I said, conversion of capital asset into stock in trade. What does it say? It provides that notwithstanding, again, if you see, everything is overriding the general charge. Notwithstanding anything contained in subsection 1, profits or gain arising from the transfer by way of conversion by the owner of a capital asset into or its treatment by him as stock in trade of a business carried on by him shall be chargeable to income tax as the income of previous year in which stock in trade is sold or otherwise transferred by him. So here it shall be the income of the previous year in which the stock in trade is sold. And for the purposes of section 48, the fair market value as on the date of such conversion shall be deemed to be the full value of consideration. So, let's take an example for this. To understand this, so conversion of capital asset into stock in trade. First of all, this is not a taxable event because this is like from one pocket you are shifting the particular property into another pocket. But this has been specifically made chargeable under section 45(2). And so is the case with the conversion of the stock in trade into the capital asset. Are we clear? So let's say I have purchased a plot of land let's say I have purchased a plot of land. Purchase the plot of land, say in 2000 for rupees 40 lakhs. For rupees 40 lakh. Okay. Now I have treated this as the stock in trade. Converted into stock in trade, let's say in 2001. The FMV as on this date is, let's say, rupees 60 lakhs. And finally, I have sold the land. Then, let's say this is in 2007. Let's say for 90 lakh. So this is the year in which it is converted and then it is sold. Clear? Now, you tell me, what is the year of the chargeability? What is the year of the chargeability? Yes, Aniket, the year of chargeability will be in 2007. Year of chargeability is in 2007. When the stock in trade is sold. What will be my full value of consideration? This will be the fair market value as on 2001, which is 60 lakhs. Which is 60 lakhs. Are we clear? Less my cost of acquisition, which is 40 lakhs. Right? So this is under the head capital gain. What will be my period of holding? Quickly tell me. What is my period of holding? Jacob, it will not be 2001. How it will be 2001? As I said, it will be deemed to be the income of the previous year in which the stock in trade is sold. Clear, Jacob? Delete the year in which the stock in trade is sold. Till when will be the period of, what will be the period of holding? From when to when you will count the period of holding? What will be the period of holding? Quickly. So period of holding will be from 2000 to 2001 up to the year of conversion. And here in this case, the period of holding will be up to the year of conversion. Are we clear? And what will be the indexation period? Same. My cost will be minus my cost will be for 60 lakhs. Cost will be this fair market value. Are we clear? So what I have charged, that particular cost will be taken while computing the PGBP as well. So FMV of the capital asset as on the date of conversion, right? So under the head PGBP, when I will compute that time, I will allow the FMV, which I have already taxed under the head capital gain, that will be considered as my cost. Isn't it? Are we clear? So my PGBP profits will be 30 lakhs. Clear? Any doubt? Shruti, the holding period will not be up to 2007 because it ceases to be a capital asset in 2001 and not in 2007. Chargeability will arise in the year 2007, but in the year 2001, it ceases to be my capital asset. What is the definition of capital asset? Property held by the assessee. Am I holding it as a capital asset? Answer is no. So therefore, in the year 2001, my period of holding will stop. Clear? Dilip, the taxability will arise in the year in which the stock in trade is sold and not when it is converted. So the chargeability will arise in the year 2007 in this particular example, right? But the period of holding will be till 2001. The chargeability is not arising in 2001. The chargeability is arising in 2007. Are we clear? Sorry. Any other question? So, as I said, for the capital asset which is converted into stock in trade, chargeability in the previous year in which the stock in trade is sold. Period of holding till the year it was held as capital asset. Indexation will also be till that year. Your fair value of consideration will be FMV as on the date of the conversion. Are we clear? And then there. Are we clear? Any doubt? Any doubt? Okay. Shall we proceed further? Okay. Now I will, as I said, explain the distinction between the conversion of stock in trade into capital asset. Conversion of capital asset into stock in trade, and this is conversion of stock in trade into your capital asset. Very quickly. Fast. Which section? No one remembers? (28) 5A. Conversion of stock in trade into capital assets. So 28 6A. We did it in the very first class of PGBP, and this is covered under 45(2). Right? Now, when the stock in trade is converted into the capital asset, the fair market value as on the, sorry, or you can write, let's write like this. Full value of consideration here will be FMV as on the date of conversion. This was in accordance with which rule? This was in accordance with which rule? Very quickly. So, what did we deal in the PGBP section? That if the stock in trade is converted into the capital asset, if the stock in trade is converted into the capital asset, then in that particular case, the FMV as on the date of conversion, the FMV as on the date of conversion will be considered as per rule 11. I'll take you to that particular notes. See, rule 11 UAB. 28 6A FMV of the inventory as on the date of jewelry and any other property, it was the fair market value. Are we clear? So therefore, your FMV as per rule 11 UAB. And here it is FMV again as on date of, then is sold. And in case of conversion of stock in trade into a capital asset, let's take an example over here. For 10 lakhs, I converted it into capital asset. SDV is, let's say, 30 lakhs in 2007 for 50 lakhs. This is conversion of stock in trade into capital asset. When will be charged PGBP, but which is the year of chargeability? You have to tell me. Yes, Dilip, you were correct. What is the year of chargeability? Yes, correct, Dilip. In the year of the conversion. The chargeability will arise in the year of the conversion. Are we clear? So here, this will be in year of conversion in which stock in trade is converted. Are we clear? Clear? Now, how the income under the head capital gain will be computed when the stock in trade is converted? So, my full value of consideration will be 50 lakh. What will be my cost of acquisition? What is my cost of acquisition? So cost of acquisition is provided under section 49(9). What does it say? Where the capital gain arises from the transfer of a capital asset under section 28(6)(a, the cost of acquisition of the asset will be the fair market value for the purposes of 28(6)(a. So here my cost of acquisition will be what? Cost of acquisition will be this 30 lakhs. The fair market value as on the date of conversion. Are we clear? What will be my period of holding? What is my period of holding over here? What is the period of holding? Vinay, it will not be 2007 but 2005. Jacob, it will be 2005, the year in which it is converted and not the year in which capital asset is sold. Clear? Yes, Aniket, you are correct. 2005 to 2007 will be my period of holding. Are we clear? And same is with the indexation. Same as with the indexation. Are we clear? Last one point, in case the stock in trade is converted into a capital asset, but the capital asset is not sold. Let's say the capital asset is continued to be used. Then in that case, for the purposes of the depreciation, if the stock in trade is converted into a capital asset, then for the purpose of the depreciation, I had told you this earlier also, under section 43, what will be my cost? Actual cost under section 43 will be my fair market value. Any doubt? Yes, Srinivasa, the surcharge of the cooperative society is this only, up over and about 10 CR, it's 12%. Any other question? Okay. So is this very, very clear? Let's say, for example, if the shares are converted into stock in trade, then what will be the effect of security transaction tax under the head PGBP vis-a-vis under the head capital gain? What do you think? What about the security transaction tax? What is it? Whether the security transaction tax is allowed as deduction under the head PGBP or not? So in case not allowed. Are we clear? Are we clear? So under PGBP, it is allowed as deduction. Yes, Dilip, you are correct. Vinay, it is allowed. Clear? Okay. Shall we proceed further? Now next is 45(2)(a), which is transfer of beneficial interest in the securities. 45(2)(a) is transfer of the beneficial interest in the securities. This is a very small section. So here, when I'm keeping my securities with the demat holders, right? The depository accounts. So 45(2)(a), what does it provide? It says that where any person has it at any time during the previous year, any participant of such beneficial interest in respect of such security shall be chargeable to income tax as the income of the beneficial owner of the previous year in which transfer took place, and shall not be regarded as income of the depository who is deemed to be the registered owner of the securities. So generally, when the securities you hold it with any of the depository participant, let's say I hold it with Kotak Securities, Zerodha, so they are considered as registered owner, but I am the beneficial owner, right, of those shares and security. So it will not be considered as income of the depository participant, but it will be considered as income of the beneficial owner. And the cost of acquisition and period of holding shall be by the FIFO method for the purposes of the determining the cost of acquisition. So when the securities are transacted, at that point in time, the brokers or the depositories are the depository participant and the income will be considered of yours. Clear? Are we clear? Next is 3. By a partner or member to a firm. 45(3) provides that when there is any interest by a person shall be recorded in the books of accounts of the firm, AOP or BOI, as the value of the capital asset shall be deemed to be the full value of consideration received. Partner to firm. Fair value of consideration will be accounts of firm. Cost of acquisition will be your actual cost. Period of holding is from the date of purchase till date of transfer. And so will be the indexed cost of acquisition. So this is the partner introducing the capital asset as a capital contribution. Time to understand, which is section 45. Very, very, very important. But before that, I would say that let's take a break, because once we start this topic, I would not be able to take a break because this will be in a continuous flow. So let's take a break of 10 minutes and then we start with 45(4) and 9p and then we'll go on till we finish off that. Clear? Okay, let's take a small break of 10 minutes. Yes, Jacob, last point of 45.3 is index cost of acquisition. It is same as the cost of acquisition. Clear? 45.4. Both are interlinked, so we are covering it together over here. First, let's talk about last year. And what does it provide us? It says that 9B1 is the trigger point or stock in trade or both AOP or BOI in connection with where a partner or specified person is receiving from any specified entity or a firm any capital asset or stock in trade or both in connection with the dissolution or reconstitution of the firm. Then what is the outcome? The outcome is it shall be deemed that the firm has transferred income. 9B, when does the head of income start? It's any
progress.
Clear? And what will be the head of income? PGBP or capital gain shall be chargeable as PGBP or capital gain as the case may be. So the computation will be under the head PGBP or capital gain as the case may be. Then 9B3 is the computational part, easier to correlate, okay? 9B3 is the computation part. What does it say? It doesn't provide the computation per se, but it just provides the fair value of consideration or full value of consideration. So it says full value of consideration will be equal to, it says the FMV of the capital asset or stock in trade on the date of its receipt by the partner will be deemed to be the full value of consideration received or accruing as a result of deemed transfer of the capital asset or stock in trade. So, receipt by the partner. So, 9B trigger point is where a partner receives during the previous year any capital asset or stock in trade or both from the firm in connection with the dissolution or the reconstitution of the firm. What is the outcome? It shall be deemed that firm has transferred the capital asset or stock in trade. Firm has transferred the capital asset or the stock in trade. What will be the year of transfer? In the year in which the capital asset or stock in trade is received by the partner. Is received by the partner. 9B2, chargeability. It will be deemed to be the income of the firm. It will be deemed to be the income of the firm in the previous year in which capital asset or stock in trade is received by the partner. And under which head? Under PGBP or capital gain. And what does 9B3 provides? Full value of be as on the date of the receipt by the partner. Are we clear? So this is your 9B. 9B4 is with respect to CBDT, power to the central government, power to the CBDT to issue any guidelines. And in connection with that, there is one circular which has been issued, which we shall be discussing later. Are we clear? Now, what do we mean by dissolution or reconstitution? We understand what do we mean by dissolution. But what do we understand by the term reconstitution? So reconstitution is defined by way of the explanation to section 9B. And what does it provide? So explanation to section 9B, reconstitution. Reconstitution of the specified entity means where one or more partners or members, as the case may be of such specified entity, ceases to be the partners or members, meaning retirement. One or more new partners or members are admitted. In such specified entity, in such circumstances that one or more of the partners who were persons who were partners or members before the change continue as partners after the change, meaning admission. All the partners or members of the specified entity continue with a change in the respective share or in the shares of some of them. So change in the profit sharing ratio. So reconstitution consists of three cases: admission, retirement, change in the profit sharing ratio. Are we clear till now? Any doubt? 9B clear? Yes or no? Okay. Now 45.4. Now what does 45.4 provides? Let's try and understand. So 45.4 again is a specific section, specific charge, right? It overrides the general charge. Notwithstanding anything contained in subsection 1, meaning it overrides the general charge. Clear? Where a specified person receives due of such specified the previous year in which such money or capital asset were received by the specified person. Did we understand this? No, again a bouncer, right? So what does it say? Let me break it down for you. So 45.4, erstwhile we used to have the old 45.4. Now this is replaced by new section 45.4. So 45.4 is not new addition. This is replacement of the old section itself. There's no amendment. There's entire replacement of the old section 45.4. What does it say? It says notwithstanding section 45.1, where a partner or a specified person receives any money or a capital asset. 9B was covering what? Capital asset or stock in trade. Section 9B covered capital asset plus stock in trade. 45.4 is covering money plus capital asset. What is common over here? Capital asset. Right? Your money is not covered under 9B, and in 45.4 the stock in trade is not covered. Right? Where a partner receives any money or capital asset from the firm or the specified entity. So where partner receives any money or capital asset from the firm in connection with the reconstitution of the specified entity or the firm. In connection with the reconstitution of the firm. Nine B was covering what? Section 9B also covered. Section 9B also covered here dissolution plus reconstitution. Here only reconstitution is covered. Clear? So this is your trigger. This is my trigger. So where a partner is receiving any money or capital asset from the firm in connection with the reconstitution of the firm. The event is the reconstitution of the firm. Then what is my outcome? My outcome is that the profits or gains from such receipt by the specified person. So profits or gains arising from receipt by the partner shall be chargeable to income tax as income of the firm under the head and shall be deemed to be income of the firm. Shall be deemed to be the income of the firm. Of which year? Previous year in which money or capital asset were received by the specified person. So, previous year, chargeability in which year? Previous year in which money or capital asset is received by the partner. So my trigger is where a partner receives any money or capital asset from the firm in connection with the reconstitution of the firm. Outcome is profits or gains arising from the receipt by the partner shall be chargeable to income tax as the income of the firm under the head capital gains, and it shall be deemed to be the income of the firm. Chargeability is in the previous year in which money or capital asset is received by the partner. Ma'am, we are still not able to understand. What is the difference between 9B and 45.4? Is that your question? Absolutely yes, right? Because you can clearly understand that yes, 9B is not covering money and 45.4 is not covering the stock in trade. 9B is the event is dissolution and reconstitution, whereas under 45.4 the event is only reconstitution. But ma'am, why two sections, right? This is what your question must be. What is the logic? What is happening? We are not still able to understand, correct? So let me make it very simple for you. Be very, very attentive and be very careful to what I'm saying. This is very important. Let's go back to 9B. Let's go back to 9B and let's see what it says. Where a partner receives during the previous year. Here also 45.4 says what? Where a partner receives during the previous year. Fair enough. Same. 9B says any capital asset or stock in trade or both. Where a partner receives any capital asset or stock in trade or both. 45.4 is saying where a partner is receiving any money or capital asset. So that we have identified the distinction that 9B is covering your stock in trade and 45.4 is covering money additionally. Capital asset remains same. Okay. From the firm, 9B also saying from the firm. Okay, again same. In connection with the dissolution or reconstitution of the firm. 45.4 is saying in connection with the reconstitution. Also we identified that dissolution is not covered under 45.4. But trigger in respect of when a partner receives a capital asset from the firm in connection with the reconstitution of the firm, trigger under 9B and 45.4 remains the same. So meaning when a partner receives a capital asset from the firm in connection with the reconstitution, 9B, 45.4 both will trigger. Correct? Very clear? What's the difference then? Difference is in the outcome. Let's observe carefully. What is the outcome? If the trigger happens in 9B, it says it shall be deemed that firm has transferred capital asset or stock in trade to the partner. It shall be deemed what? That the firm is transferring the capital asset or stock in trade to the partner. Why? Because there was the earlier Supreme Court judgment which said that the firm and the partners are same. Firm cannot transfer to the partners because both are part of each other. To override that, 9B came into picture to say that this will be deemed that firm is transferring the asset or the SIT to the partner. Outcome. Clear? Outcome of 9B. What is the outcome of 45? Listen very carefully. Profits or gains arising from the receipt by the partner. Here, they are not saying that it is deemed to be the transfer of capital asset or stock in trade by the firm. Read it very carefully. Anywhere it is written, is it written anywhere that this will be deemed to be the transfer of the capital asset or stock in trade by the firm to the partner? No. What is written over here? If the trigger points of 45.4 are fulfilled, profits or gains arising from the receipt by the partner shall be chargeable to income tax as the income of the firm. But this is whose income at the first place? 9B, it is the income of the firm only. 9B, if you see, it is the income of the firm. It shall be deemed that the firm has transferred the capital asset or to the SID to the partner. So under 9B, this is the income of the firm. Under 9B, this is the income of the firm. Are we clear? Right? But under 45.4, it says profits or gains arising from the receipt by the partner. So when the partner is receiving the money in excess of his capital contribution, the partner has contributed capital, right? Either at the time of now he is getting admitted, or even when he's retiring, he would have contributed earlier. So something the partner is losing, right? And he's gaining over and above that. So the profit or gains which are arising from the receipt by the partner. So this is the income of the partner. And not of the firm. But this is chargeable to income tax as the income of the firm. So income of the partner chargeable to income tax as income of the firm. Are we clear? So now did you understand what is the difference between 45.4 and 9B? 45.4 is this is the income of the partner, and 9B is the income from deemed transfer by the firm. Clear? So this is the income of the partner which is chargeable in hands of firm. Under the head capital gain shall be deemed to be the income of the firm. This shall be deemed to be the income of the firm. There, if you see, there they nowhere says that this will be deemed to be the income of the firm, because that income is of the firm only. So what do they say is it shall be deemed that the firm has transferred the capital asset or SIT to the partner, and therefore this is deemed to be the income of the firm in the previous year in which capital asset or SIT is received by the partner. Here, this is the income of the partner arising from the receipt by the partner, which shall be deemed to be the income of the firm of the previous year in which money or capital asset is received by the partner. Are we clear? Did you understand this? Perfectly clear? Okay. Now, once this is clear, 45.4 gives the computation. What gives you the computation? What is the computation? It says that A equal to B plus C minus D. A is your capital gains. B is your value of money received. Value of the money received, right? C is fair market value of the capital asset received on the date of receipt. And D is the capital balance in the books of accounts capital balance in the books of accounts of the firm as on the date of reconstitution. Are we clear? B plus C minus D. Money received plus the FMV of capital asset as on the date of receipt minus the capital balance in the books of accounts of firm. This is your computation. Right? Are we clear? Now, what does it additionally provide? Let's try and understand. So it says that if the value of A is negative, there cannot be losses. So if value of A is negative, consider 0. There cannot be losses under this particular section. It will be deemed to be 0. And for the purposes of the capital balance, ignore revaluation and self-generated goodwill. Ignore revaluation and self-generated goodwill or any other self-generated asset. So increase in the capital account due to any revaluation or any self-generated asset or goodwill, that shall be ignored. Are we clear? Any doubt till now? Clear? So let's say if I have increased the capital account by the revaluation which has happened during the year. So you have to ignore the revaluation or ignore the self-generated asset or goodwill. Are we clear? Any doubt? Okay. So just write it down over here. 9B versus 45.4. This is event is reconstitution and dissolution. This is only on reconstitution. Here it covers asset, capital asset plus stock in trade. Here it covers capital asset plus money. Income of deemed transfer by firm to partner. And this is profit and gains from receipt by the partner. Deemed to be income of firm. Are we clear? Clear? Any doubt? So if there is reconstitution and if the partner receives capital asset, then 45.49B both will apply. So 9B and 45(4) both will be applicable where partner receives capital asset from the firm in connection with the constitution. Clear? Okay. Any doubt? Okay. Now, let's understand this by examples so that you would be able to appreciate how exactly we need to consider this particular thing. So let's say, now I'm only going to discuss with the examples. Example 1, right? Let's say this is the balance sheet of the firm. This is the balance sheet of firm. There is a land in the balance sheet of the firm. There's a land in the balance sheet of the firm, right? This is of rupees 20. There are two partners, A and B. Capital balance is 1010, right? Now, FMV of the land as on the date of receipt is 200. Partner A is retiring and partner C is admitted. So there is a reconstitution of the firm. Now A is paid cash. A is paid cash of rupees 100 as his share of asset. As his share of asset. So there is this revaluation, right? There is this revaluation in the FMV, correct? So his share of land is 100. That is being transferred or paid, sorry, that is being paid to A. Asset is not transferred. Asset is not transferred over here. So here, if you see, you need to tell me what will be 45(4) and what will be 9B. If you have understood so far, you would be able to tell me. What is 45(4) and what is 9B? No. No, Vinay, that's not the correct answer. Burmic, yes, correct, but partially. No, Vinay. Okay, let's understand. First of all, tell me whether 9b is applicable or not. By the time I give you the answer for 45.4, you need to reply to me whether 9b is applicable or not. So 45.4 is what? A equal to B plus C minus D. I have received 100, which is B. I did not receive any capital asset, which is 0. Minus D, my capital balance is 10. So 45.4 is 90. Whether 9b will be applicable over here? The answer to that is no. Because when is 9b applicable? When a capital asset is given. Here, the money is given and not the capital asset. So here, 9b will not be applicable as capital asset is not transferred. Are we clear? So here 9b is not going to be applicable. Clear? Let's say, let's take an example. Same this example. Let's say there is this balance sheet of the firm. Partner A and B are there. Share 10-10. There's this capital asset, the cost of which is 10. FMV is 100. Now A is retiring and the capital asset is given to the A. So in this case, the capital asset is given to A. In which case, what will happen? In which case, what will happen? In that case, there will be 45.4 and 9b both will be applicable. So under 9b, capital asset is transferred to A. So 9b, your full value of consideration will be 100 minus cost 10. So 90 will be taxable under section 9b. Right? Under 45.4, B is 0 because money is not given. C is 100 minus 10 is D. So 90 will be taxable under 45.4. Right? So therefore, in effect, there is a double taxation which is happening. There is a double taxation which is happening, isn't it? So is this double taxation specifically which is happening? Will we let this happen? For that purpose, we need to see section 48.3, new section. And what does section 48.3 says? Section 48.3 says, where any money or capital asset. So section 48.3 is the computation. First of all, section 48.3 is a computation provision, right? It says in case of value of any money or capital asset received by the specified person from a specified entity under section 45(4), the amount chargeable to income tax as the income of the specified entity which is attributable to a capital asset being transferred by the specified entity, calculated in the prescribed manner. Very complex to understand, isn't it? Very difficult. We didn't understand. Let's make it simple. What does it say? In case of value of any money or capital asset received by the partner from the firm, which is referred to in 45(4), the amount chargeable to income tax as the income of the firm, which is attributable to the capital asset being transferred by the firm, is allowed as the deduction from the computation of the capital gains. Still didn't understand. Let me make it very, very simple for you. So, 48(3) was introduced to mitigate the double taxation. The memorandum to the finance bill mentioned the reason for 48(3) amendment was that this is to mitigate the double taxation which may have happened, but because of this provision, where an asset which is revalued and for which income under the section 45(4) is taxed, is subsequently transferred by the firm, there the deduction will be allowed. Ma'am, we are still not able to understand. Okay, small principle that this is to mitigate double taxation. That is clear? Now understand one thing. Income tax fundamental principle is that we can only tax the realized gains unless there are specific exceptions where unrealized gain is also taxed, right? So under 9B, when the firm is transferring the asset, under 9B, when the firm is transferring the asset, you are taxing the realized gain of the firm, right? Under 45(4), what are you taxing? The appreciation in the partner's share. Appreciation in the partner's share because of the revaluation that has happened in the firm. So in this case also, if you see the example which we were just discussing before, the firm had revalued the land at 200. His share, the partner's share, was 100. The firm has not yet realized 200. Firm has not sold the land. Firm has not yet realized 200. In 9B, when the firm is transferring the asset, the firm has realized the amount. In 45(4), firm has not realized the amount. The firm, the income is of whom? Partner. But it is chargeable in the hands of whom? Firm. The liability is shifted to the firm. The firm has not realized the fair market value of the land because it has not sold the land, it has just done the revaluation. The partner is taxed on the realized gain, right? But the liability is shifted in the hands of firm. So ideally, when the firm should have been taxed? When the firm will transfer the land. When the firm will sell the land, it will realize the capital gain, it should be taxed then. But because of the virtue of 45(4), firm is taxed today on that appreciation because of the partner's liability getting taxed in the hands of firm. Firm is getting taxed today. So there is preponement of liability. Clear? There is preponement of liability, and to that extent 48.3 says that tomorrow when you will sell the asset, when you will sell the asset later, when you will sell the land later, the amount charged under 45.4, now you will understand. In case of value of any money or capital asset received by the partner from the firm, referred to in 45.4, the amount chargeable to income tax as the income of the firm, which is attributable to the capital asset being transferred now. The capital asset earlier was not transferred. The capital asset is now being transferred at a later point, will be allowed as deduction. So amount charged under 45.4, which is attributable to the capital asset transfer, will be allowed as the deduction. Because we have taxed you earlier, now we will allow you the deduction. Clear this logic? Any doubt? So just write it down. Nine B taxes the gain realized by the firm on transfer of capital asset to partner. 45.4, the firm has not realized the gain on the capital asset revalue, right? This is the unrealized gain. The firm will realize when it will transfer the capital asset. However, the firm is being taxed on the share of partner realized by him at the time of reconstitution. Therefore, there is preponement of tax liability. Right? So 48.3 neutralizes the taxation which is preponed by allowing deduction of gain already taxed under section 45(4), or you can write unrealized tax, unrealized gain, already taxed under 45(4) when the gain is realized by firm on subsequent sale of asset. Are we clear? This is not applicable if 48(3) will not be applicable if tax is under 9B. Because under 9B you are taxing the realized gain only. Clear? So in this situation, 48(3) will not be applicable. So no deduction if A is 0 because it is not taxed, or when there is 9B. Clear? Or when the 9B is applicable. Clear? Now what does it say? It says, if you see, it says, which is attributable to the capital asset being transferred by the specified entity, calculated in the manner prescribed. So prescribed manner is under Rule 8AB. Under Rule 8B, the manner is prescribed as to how to compute 48(3) deduction. But before that, if you see this illustration, where 45.9 rupees is taxed. This, not this illustration, sorry. Let me give you another illustration. So let's say if under 45(4), one second, I've given you the illustration. I think this one, yes. Where the cash of 100 is paid, right? So now your 90 is taxed under 45(4), right? Now when the firm will sell this particular land, so when then capital gain would be what? Let's say at rupees 300 it is selling. So capital gain equal to 300 minus, let's say index cost of acquisition is 20 only, or let's assume cost of acquisition 20. So capital gain will not be 280. My capital gain will be minus deduction under 48(3). $90. So net capital gain is 190. Net capital gain is 190. Clear? So this is how you need to compute your deduction. Yes, Vinay, I would cover from the bare text only. Don't worry. Are we clear till now? Fine? Okay. Now, what does Rule 8AB says? Let's try and understand. Rule 8AB. So, let's understand what this Rule 8AB says. Now, the computation is given under 48(3), but it says in the manner prescribed. Now, manner prescribed is under Rule 8AB. 8AB is divided into several segments. Let's do one by one. Okay. So, first 8AB1 says for the purposes of 48(3), the amount chargeable to income tax as the income of the specified entity under 45(4), the specified entity shall attribute such amount to the capital asset remaining with the specified entity in a manner provided in this rule. Now, what is the rule which is there? So there are three parts to it. First part is the amount to be attributed. Second part is the amount not to be attributed. Correct? The amount to be attributed, the amount not to be attributed. So let's see 8AB rule 2, sub-rule 2 is attribution, and sub-rule 3 and 4 is not to be attributed. Clear? Now, if I will explain you from the bare text, you will not understand it very simply. So let me give you example and then let me help you with the bare text of the rule. Then you will be able to appreciate the difference. Okay? Let's say this is my balance sheet of the firm. First, I am talking about rule 8AB2. Right? First, I am talking about 8AB2. Now, 8AB2 which is there, 8AB2 which is there, let's say the partners are A and B. Right? Two assets which are involved. So what does rule 8AB2 says? Now you read and you will understand this. It says where the aggregate of the value of money and the FMV of the capital asset received by the specified person from the specified entity in excess of the balance in his capital account chargeable to tax under 45(4) relates to revaluation of any capital asset or valuation of a self-generated asset or self-generated goodwill of the specified entity, the amount attributable to the capital asset, the amount attributable to the capital asset remaining with the specified entity for the purposes of 48(3) shall be the amount which bears to the amount charged under 45(4) the same proportion as the increase in the or recognition of the value of asset because of revaluation or valuation bears to the aggregate increase in recognition or value of all the assets. So what does it mean? So here 90 rupees which is there. So here I will attribute this 90 in the ratio of 60 which is on account of X is to 120 which is the appreciation of Y, right? And 48(3) therefore will be 30 and 60. So when I will sell X, I will get deduction of 30. When I will sell Y, I will get deduction of 60. Are we clear? Clear? So it has to be in the same proportion as the increase in the asset. Are we clear? So when there are two assets, this is how I will explain you with the example. Or 8AB3. Now what does it say? So again, I have the balance sheet. I have two partners, A and B. My profit sharing ratio is 50-50%. Capital is 50 and 50. There are two assets, X and Y. X is stock in trade and Y are debtors. Now my book value is 20 and 80. My fair market value is 80 and 80. Now for the purposes, A is retiring and C is admitted. Cash of 80 is paid to A. Right? So 9B is not applicable because cash is paid. 45-4, very simple, 80 minus 50, 30. Whether 48-3 is applicable? So for this purpose, let's understand rule 3 and what does it say. So rule 3 says where the aggregate value, where the aggregate of value of money and the fair market value of capital asset received by the specified person from the specified entity in excess of the balance in his capital account charged to tax under 45(4) does not relate to the revaluation of any capital asset or valuation of self-generated asset or goodwill. The amount charged to tax shall not, under 45(4) shall not be attributed to any capital asset for the purposes of 48(3). So where the amount charged under 45(4) is not relating to revaluation of any capital asset. Is stock in trade a capital asset? Answer is no. So where amount charged to tax under section 45(4) is relating to revaluation of not relating to revaluation of capital asset, no attribution under section 48(3). No attribution under section 48(3). Are we clear? Clear? So if it is not relating to capital asset, then no attribution. Because here it is stock in trade, there will not be any attribution. Clear? Rule 8AB4. Again, I'll explain with the example. What does it say? Let's say, again, I have partners A and B. My capital is 50-50. I have assets X and Y. This is a capital asset. This is others. My book value, my fair market value is 80 and 80. Clear? Now A is retiring and capital asset X is transferred. Are we clear? If the capital asset itself is transferred to the partner, here the attribution will be 0. Are we clear? Clear? Here 9B will also be applicable. What will be my 9B here? 9B will be again 80 minus my cost. 9B will also be applicable, sorry, 80 minus 50. So here my 9B will also become applicable because here capital asset is transferred. Yes, so here double tax is happening. Here double tax is happening. Are we clear? Any doubt? So I'll just quickly recap. Here, if you see the first example, what here the land was not transferred, but the money was transferred. Correct? So 9B not applicable, 45.4 is applicable. Here 45.4 will be my 100 rupees which is given minus the capital balance which is 10. And we will get deduction under 48C because when the asset will get sold, asset is not sold. Here at the moment only the money for the revaluation is paid. Attributable to asset, the amount of tax under 45, sorry, the amount charged under 45.4 which is attributable to the asset will be given. At that time, I have, because the mechanism to attribute if there are multiple assets. So 48.3 will be divided in the proportion of the revaluation. So 45.4 amount which is there will be divided between the assets in the proportion of the revaluation which has happened. But it says that the 48.3 attribution will not happen if the revaluation relates to other than capital asset. Then 45.4 amount will not be attributed to the asset because it should be in relation to revaluation of capital asset. And if the asset itself is transferred to the partner, then there will be again no attribution to that particular asset. Clear? That is rule 4. Any doubt? Any questions? Any doubt? Okay. So if there are no doubts, there is one more circular which we have to cover. There is a circular number 14. Which we can cover tomorrow, but I want you to revise this very thoroughly before we go on to that circular, because then we will be able to link everything tomorrow once we finish off this circular. But I want you to very thoroughly go through each and every part of this because this is very complex provision. Are we clear? Any questions, any doubt? Is this clear till now? In case you have not understood, I can repeat it, but be very clear with this provision. Okay. So if there are no further questions, I assume that there are no doubts. So we'll meet day after tomorrow, but please do revise because this is very, very important concept. So thank you so much.